Investing in stock markets. Some facts and opinion. For long term investing, exits are difficult to master, and 90% companies will destroy wealth. Otherwise, everyone would have been rich. The biggest mistake will be trying to become rich quickly. If you have a job or other work as primary source of income, focus on building skill, competency in that area, and invest savings in index funds. Points and opinions to support this idea. In 2007, Warren Buffett bet $1 million that an index fund would outperform a collection of hedge funds over a course of 10 years. Over the course of the bet, S&P 500 index fund returned 7.1% compounded annually, significantly more than the basket of funds selected by an asset manager at Protege Partners. That basket only returned an average of 2.2%. Cartoonist Scott Adams has also written some of the best personal finance advice that I have ever read. He calls it Everything You Need to Know About Financial Planning. The book is 87 words long. That's words, not pages. Here it is in its entirety. Make a will. Pay off your credit cards. Get term life insurance if you have a family to support. Fund your 401k to the maximum. Fund your IRA to the maximum. Buy a house if you want to live in a house and you can afford it. Put 6 months' expenses in a money market fund. Take whatever money is left over and invest 70% in a stock index fund and 30% in a bond fund through any discount broker and never touch it until retirement. Still want to continue investing in stocks? Carefully select a role model and listen to their advice. Good starting point could be listening to videos of Warren Buffett and Charlie Munger on YouTube. Concept of market taken from Charlie Munger's videos. The model for market is common stocks, is something like pari-mutuel system at the racetrack. Any damn fool can see that a horse carrying a light weight with a wonderful wind rate and a good post position, etc., is way more likely to win than a horse with terrible record and extra weight, and so on and so on. But if you look at the odds, the bad horse pays 100 to 1, whereas the good horse pays 3 to 2. Then it's not clear which is statistically the best bet. However, there are actually a few people who can beat the game after paying the full 17% to house. The stock market is the same way, except that the house handle is so much lower. How do you get to be one of those who is a winner, in a relative sense, instead of a loser? Here again, look at the pari-mutuel system. And the one thing that all those winning betters in the whole history of people who've beaten the pari-mutuel system have been quite simple. They bet very seldom. And the wise ones bet heavily when the world offers them that opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. Some quotes. Rule number 1: never lose money. Rule number 2: never forget rule 1. The stock market is designed to transfer money from active to the patient. Time is the friend of the wonderful company, the enemy of the mediocre. Diversification is protection against ignorance. It makes little sense if you know what you are doing. The investor of today does not profit from yesterday's growth. It takes character to sit with all the cash and do nothing. I didn't get to the top where I am by doing after mediocre opportunities. What are the success of success? The one word answer: rational. If you don't get this elementary but mildly unnatural mathematics of elementary probability into your repertoire, then you go through a long life like one legged man in an ass kicking contest.